You're listening to 2025 The Final Drive, What You Need to Win with David Hayes. David has been providing financial advice for over 25 years and is the host of Your Money with David Hayes radio show and podcast.
Now, in this episode, I'm not going to talk about IRAs, believe it or not. I'm going to be talking about gifting. When I gift something to someone, what happens? Well, this is a real case scenario that happened just about a week ago in my office. And I always say to people, after 28, 29 years, you never know what's going to walk through that door. Now, this is not a unique situation. This is actually quite common. But she did not know how to handle it. So Mary wants to give her house away to her son, but she doesn't know how that would work. So it was a rental house. The son actually lived there. She paid $135,000 for the house 10 years ago. It's worth about $200, assessed around $186, and she wants to give the house to the son. The son doesn't want it given to him. He wants to buy it. But here's the issues we addressed. What if you give it, or what if you sell it? Let's talk about selling first. First of all, it's not her personal residence, so it's treated as an investment property. She didn't live there 2 of the last 5 years, and that's the qualification for a personal residence. She depreciated the house for tax purposes over the last 10 years, so she has about a $95,000 cost basis. So basically, if she sold it for even a discounted price, say she said, "Oh, I'm going to sell it for $150," which is still a fairly okay price because anything you sell for less than they call fair value is considered a gift. So now we're back to the idea of, okay, well, what's fair value? I'd probably go with the assessed value, the 186, even though she probably could get 200. By the time you paid realtors and all that, you can justify 186. And plus, that's the assessed value. Just make a copy of it, stick it in your folder, and that would be your staple. But let's say she did sell it and she sold it for $150. Well, first of all, she has to recapture the $40,000 of depreciation that she took over the last 10 years at a maximum rate of 25% plus her 5% state and local, or 30%, or about $12,000. Oh, but wait, there's more. What about capital gains on that extra $15,000, which was the $135 minus the $150? Again, at a 15% cap gains rate, another 5 on state and local, that's another $3,000 or $15,000 total tax if she sold the house to her son. Oh, by the way, there was a little more. When I did the evaluation analysis, we found out that with her other income, that would put her up over a Medicare surtax threshold, and she would be paying higher Medicare premiums for another year. That wouldn't catch up for another couple years, but she would pay it for an entire year with no exception. Is there another way? That's the question, right? She's sitting there. Is there another way? Well, I'm glad you asked. Let's go back to the gifting idea. Tap the brakes before you do anything. Tap the brakes. Because if you would like to talk about how we can help you navigate these complicated issues, please go to cfci.us. Contact us there. Set up your complimentary call. I did one today. It was 20 minutes long. It was great. Helped out some folks. Or give us a call at 812-334-3190, and I promise you, we will make it happen.
Thank you for listening to this podcast. The clock is ticking. Each decision that is made today will put more money into your pocket or leave you worried about your financial future. The time to prepare is now. The time to eliminate risk was yesterday. Let's partner to help those around us to make decisions that empower their financial future. If you would like to book David for a speaking event, please contact CFC at cfci.us. You can purchase his book, 2025 The Final Drive, into www.cfci.us and clicking on 2025 The Final Drive.